So I started the recording. Good morning, everyone. This is Amit Kumar Singh. Welcome to the first class of online on subject called corporate financial modeling. So uh, talk, talking about what is happening in the market, I believe you all are tracking the market. And right now, when we see Nifty or Sensex, uh, from last 1 week, it has shown some positive movement. So right now Nifty is trading around 9,860. Sensex is around 33,700. Guys, I'm hearing a lot of noise. So on mute. So when we see the market right now, we can see Nifty and Sensex probably audio problem. 1 minute. Everyone else, are you facing some audio problem? Okay. Please message in case if you're finding any difficulty. So I already started the recording. So when we see Nifty and Sensex, Nifty is trading around 9,860. Sensex is somewhere around 33,700. So both Sensex and Nifty is showing positive movement as compared to what we can see in the foreign market. So except Chinese market, more or less all the market are trading in negative or red zone. So probably all the CEOs around the world, they're expecting that this time the revenue for this quarter will decrease more than 40%. Don't expect any kind of salary hike or any kind of job recruitment probably for the upcoming season. So we can now the future trend will be much more negative as to what we have seen till now. So probably when we talk about Indian market, it's somewhat positive. Indian market right now is somewhat positive, maybe because of the kind of action or the kind of response the government of India and Reserve Bank of India, they both are doing in somewhat to revive the economy. So around 1.7 lakh crore is being put by government of India to support the poor and underprivileged class. Similarly, the Reserve Bank of India came up with a package of around 50,000 crore because the objective was to revive the mutual fund industry. RBI, I think from last 2 months, right now today is our 41st day of lockdown. The lockdown was started around I guess around 25th March. The lockdown which has started around 25th March. Now today is the 41st day of our lockdown. So we have seen a lot of uncertainty within these time. Although the government of India, although the RBI, they came up with a package, but similar kind of steps we are expecting for medium and small enterprises or maybe for tourism industry. So because they are gonna get affect worst, either it is hospitality industry, either it's a tourism, so they're gonna affect a lot. So let's see what's gonna happen to the market. Anyone want to comment on the market? Anyone want to say anything about the market? So guys, I'm hearing a lot of background noise from I don't know from where I'm getting. So if in case you want to speak, let me know. I'll unmute you. But for the time being, it's better that everyone is in mute stage. So guys, anyone want to comment on the market? What is happening in the market? Rashmi, it's okay. You can switch off the camera. Anyone want to comment on the market? What is happening around the market? Just message me so that I can unmute you. So anyone is tracking market, anyone is aware about what is happening with the market. So it's very important, guys, that as a student of finance, we should have a track about what is happening around us in the term of market. So dollar, rupee, so $1 is right now around 75 rupees. Gold is trading around 45,000. So gold, which I believe 2 months before was around 36,000 rupees. Now it is trading around 45,000 rupees. Silver is around 41,000 rupees per kg. So So this 30th March was the last day of the expiry of derivative contract. At the same time, last week the trading was there only till Thursday. Uh, so India is facing loss 50,000 crore every day. Yes, Gaurav. So Friday American market went down by 600 point. Very good, Ravinder. So American market, to definitely we can expect. We know the reason also why they are worst affected, and and definitely, Ravinder, if negative thing happened in on Friday in either in any American market, any market around the world, definitely is going to affect our market today. I believe if you open the market today, if you see the market right now today, you can see my screen. If I open today market, so let's open money control. So if you open today market, we'll see market in negative zone. So right now from 9 to 9:15 pre-market hour session used to happen. So I believe you can see my screen. You can see Sensex Nifty. So they have fallen down around 4%. And so Thursday Nifty was around 9,860. And today you can see Nifty right now at 9,400. So for around 425 point Nifty has fallen down. Sensex was around 33,700. You can see Sensex is trading around 32,000. So definitely whatever, like, because Friday trading does not happen in our market. Friday was the holiday. So it was very obvious that our market would have been affected. Gold is around 545,520. So definitely you can see when these market will fall down, definitely the gold will go up. So you know the reason why there's a negative correlation between the gold and the equity market. Anyone want to comment anything? What is happening around on the news front? Meghna, you want to add something? Need to rush me, anyone? Please write in the chat box. Anyone want to say anything? So although if you see the last 1 week, the best performing stocks, you can see still Reliance Industry is supposed to be right now the best performing stocks. Reliance Industry or TCS or HDFC Bank, HDFC Limited, Kotak Mahindra Bank, ICCI Bank. The more or less the banking sector has shown very good positive what you say movement because of the continuous effort of Reserve Bank of India. So the most volatile market would be the Bank Nifty. The most volatile place where you can make money right now is Bank Nifty. Or if you want good investment, you can go for FMCG or pharma. FMCG or pharma, probably they are the sectors fundamentally which are very strong right now. Otherwise, if you look for short-term trading, the best stocks to invest would be based on banking sector. If you see last 1 week, the top movers, they are Reliance Industry, TCS, HDFC Bank, Infosys, Bharti Airtel. Why Bharti Airtel? You know the reason, because with the lockdown, we all have to stay in home. So probably we need more and more internet. So again, there's a demand. Again, there will be a demand in this front. So you can definitely expect a good movement. So anyone want to say anything, comment anything about the market? So recently, there's a American pharma company called Glide. They have developed an antiviral drug called remdesivir. So they're talking about this drug can be again very good option for them for the anti-corona. So everyone is coming with some kind of alternatives for the corona. So let's see what is going to happen. Ravinder is saying that Mukesh Ambani lost for $5.6 billion on the back. Very good, Gaurav. So yeah, so that is the scenario. People like uh, Elon Musk, because of his one tweet, and he lost around $14 billion. So if we compare with Elon Musk, so 5.6 anyway is less, but even then it's big amount. Neetu is saying that Silver Lake to invest around 5,000 crore in Geo platform. Yeah, so Geo is again that internet segment, either Geo or you read about Facebook, they have done investment in Reliance Geo. So again, these all are one or two the hot picks right now. Ravinder is saying that a month back, Yes Bank share went to 60, but now it is around 60, 27. Yes Bank is not progressing. Why? Yes Bank, why it's not progressing? A very good question. Ravinder has asked very good question. That last around 1 month back, Yes Bank was around 60, but now it is trading around 27. So ye jo 60, 27, whatever is happening is because it's not happening because of fundamentally, guys. We need to understand this. It went to 60 because of this all what you say, the trading front. Those people who are trading, they're just doing for the profit booking. So you have to understand fundamentally nothing very big has happened in Yes Bank. So there were news that SBI and other banking front, they're gonna invest their money into Yes Bank. If that gonna happen, probably the Yes Bank would get revived and all this thing is gonna happen. But again, because of Corona epidemic, so that focus was shifted from Yes Bank to something else. So fundamentally, you can't expect that suddenly from 27 rupees something becomes 60 and again from 60 something becomes 27. So that is not fundamentally, that is not happening around fundamentally. So that is all about what you say, the kind of profit booking which is being trying to done by some set of brokers, and that is ultimately that is going to happen because fundamentally you know that Yes Bank was struggling and is going to struggle for the long period of time till the time they don't do the asset restructuring of Yes Bank. Okay, so now probably I can see Meghna is saying that around 6,000 Indians from foreign countries will come back to India, so the demand for real estate sector will increase in the future. Okay, Meghna is putting good, very good opinion. This is very good. I believe the source from where you read the newspaper was very authentic source, and because that is definitely a lot of NRIs are coming back, will be coming back to India, or they are coming back to India. So we can expect some kind of what you say, optimism in front of real estate. But I don't think, Meghna, my personal opinion, Meghna, I don't know, that I may be incorrect also. So everything is based on personal opinion, because I believe all the people who are coming back to India, so no matter how much assets are left with them, they will try to what you say, secure the assets. They may go for bank FD and other avenue for investment, but going for real estate sector would be a little bit risky. So I cannot comment on that front. So because all the people who will come back to India, it's not like Indian corporate sector will welcome them with open heartedly that please come back to India and lot of job opportunities are waiting for you. I don't know how the things will resume in future, because people are saying that many Chinese company are gonna leave the China and they're gonna invest in countries like India, Vietnam, or Indonesia or Malaysia. They're gonna do investment in these countries. If such things like this happens, probably we can expect some good move in the market. But again, I'm not so much bullish on that front, because you know that the political tussle which is happening within the states, like you remember the BJP in Maharashtra, they started this bullet train concept between Ahmedabad and Mumbai. But when Uddhav Thackeray came in power, so he put that project on hold. So these kind of political tussles, these things, although whatever we talk about, we cannot come out with such kind of euphoria around us. So we all try to presume or assume that we can be better than other, one government better than other. I hope you remember the story that Navasa, that Pune, Bangalore, Pune, Mumbai, the Lavasa project, which was considered to the most high-end project which can happen in India, and that has started. And there's a group which was doing that investment in Lavasa, and because that whole project goes on toss because of the interference. As for the source, I not be very good person to comment on that part. But as per the source, because of too much interference of Congress, that Lavasa project went on toss. So whenever the Indian corporate, they try to go one step further to show some kind of better improvement in regard of infrastructure or in regard of technology, there would be some kind of political tussle between different political parties, and that will again to push back uh, us in little bit back. So that is the what you say. That is the irony of democracy. So democracy has its own advantage and disadvantage. Probably I can say this could be the disadvantage of having democracy. So Gaurav is saying that Ambani emerged to be second biggest loser after Mark Zuckerberg lost around 4.5 billion last week, more than anyone in Forbes billion list. That very good, Gaurav. But again, this Mark Zuckerberg lost something or Mukesh Ambani lost something. So these all are temporary. These all we are talking in the term of their what is happening to their performance in stock market. So we need to understand that the stock market goes ups and down, and fundamentally, Reliance Industry is the best stock. If you want to invest, you can blindly invest in companies like Reliance Industry or TCS or Infosys or HDFC, ICCI, Kotak Mahindra. This would be the future. Uh, if you go for short term, then probably we need to be a little bit tensed on these front. But when we talk about long term, so we don't have to worry about these front. So Ravinder is saying that around 30 lakh people are employed in Saudi. Saudi government want to send them back so that this would create high rate unemployment so they can force back. Yeah, these things are definitely going to happen. And so these all people from abroad, this way or that way, they may come to India. But again, I think when the situation will become normal, they will again go back to the respective destination, because again Dubai market or maybe other Western market, again they will have the requirement of job. So again they will pull back these resources. So we Indians are very strong, and probably for us it's not a big thing. We know how to change ourselves, our change of gear. So when the things will become normal, again you see lot of migrant worker from Bihar or UP or from other part of the country. They are in Kerala or they are in Maharashtra or in Punjab. Around 10 lakh migrant worker are in Punjab. Around 30-40 lakh migrant worker are in Kerala. They all are trying desperately to go back to their native. But once the things will become normal, again they will go to Mumbai or Punjab for working. So like the same way, so you can consider these people are living in UAE or maybe in other parts of the world, Qatar or Kuwait. So once the things will become normal, again they will go back to their places. That kind of assumption we can stay with. Reality, what is going to happen? We still be not sure about the reality. Ravinder is saying that a week back I heard news that crude oil went to negative. That crude oil went to negative, Ravinder, it happened in future market. It happened in derivative market, and that happened to the one segment of American crude market. So that has not happened into the international market. In the international market, when you see there are lot of what you say groups are there which determine the crude price. So one of the we trade in Brent crude oil. So we Indians we trade in Brent crude oil, and for us it does not affect it much. What you read in newspaper and other places that the crude oil price went to around a negative, that has happened in Texas. There's a group which works on primarily in America front. So they are on the derivative market because it was Friday and they had lot of reserve of crude oil with them, and continuous production of crude oil is happening around the world. Because the tussle between the Russia and the Saudi Arabia on the crude oil front, pricing front. Now that issue is being resolved, and again America is the largest producer of crude oil right now. So they have produced too much, and they don't have even any avenue to store that. And again that continuous production was happening. So in the derivative market, that the price which has become negative around $13 per barrel, all that, it has happened in derivative market, not in the spot market. So So I hope you understand that, Ravinder, that news was in derivative market in the future segment on Friday. That has happened, and that has happened in the American market. So we Indians don't trade with the American index on the crude. Anyone want to speak? Anyone want to say anything? Anyone have anything? Please raise your hand. If you want, I can unmute you. Because the problem with doing that is a lot of background news I'm hearing. Prakash, you want to say something? You can write in the chat box. Definitely. When you talk about tourism industry, hospitality industry, they are getting affected a lot. So especially the segment like airline segment, it is very capital intensive. What is extensive segment where a lot of capital required. Recently, the Air France, the French government, they have introduced a fiscal stimulus to their airline industry. The same thing need to be done by Indian government also. Indian government, when we talked about mutual fund and poor people till now, but Indian government is not understanding the problem which middle class people is facing currently. Although the government is saying that to the that home that who that owners should not ask for rent, and the company should pay salary. But you know the events which is happening around us. So majority of Indians who are working in hospitality segment or in service industry, they are getting around 50% of the salary. So that is the reality, guys. So this is how we need to raise hand. So you can, instead of raising hand, it would be better if you can write in the chat box. And so raising hand, so it would be better. Whatever you have, please raise your hand. Prakash, so no need of video, Prakash. We'll communicate with each other in audio front or in the chat front. Anyone else want to say anything? Anyone? Amit want to add something? Gaurav, Pooja, I hope you are listening to us. You want to add something? Anyone? No, I believe now everyone is silent. So talking about anyone? Okay, fine. So guys, again I'm telling you, the future is gonna be very difficult. So it's my really suggestion for all of you that please, so please, like, start working more hard, do more hard work. Okay, so please do more and more hard work. So because the things will gonna be very difficult. So if you, so jobs and all, you can see a lot of what you say, negative sentiment around us. So I'm telling you again, do more and more hard work. Prepare yourself for the worst time. I'm telling you, read newspaper, read what is happening, work hard, learn whatever you can learn, because things gonna become very negative. As per the news, the Nifty was around 9,800 support and resistance. They're expecting around 9,700 to 9,900. We don't know what's gonna happen to the market. So maximum open interest when we see the market. So in the call segment, the maximum open interest is building around. When you see the call market, the maximum open interest is building up. So it's building up at 10,000 in the call market, the call option. While for the put option, when we talk about for the put option, the maximum open interest is building around 9,500. is building around 9,500. So probably they are looking for writing of the put. I hope you still remember. I hope you still remember the diagrams and all. So Nifty, if it 9,500, this is 10,000. So the people are assuming that maybe in next 1 or 2 months, the Nifty will trade around, will go beyond 10,000, and those who are little bit negative, they are taking short position at 9,500. I still believe you remember about the pricing, the payoff diagram in options. So read newspaper, read what is happening around us. It is very important for everyone to understand the events which are unfolding around us. Yeah, Facebook, yeah, Pooja has said that Facebook and other private equity firms, they all are investing in Reliance Jio. So, you can understand the future is going to be internet. So whoever who is not in internet, they were not going to survive, as what was long back Bill Gates has said. So we understand that is the future. Anyone else want to comment on anything? Okay, so I believe you all are listening to me. So today in this class, I want to teach uh, on real options. So we are studying in corporate financial modeling. We are studying about corporate finance. We are talking about corporate finance, and when we study about corporate finance, we ourselves are seeing lot of momentum in corporate finance. Lot of things are happening around us in our corporate sector. So all the sectors more or less are affecting a lot. So when we see corporate finance, when we see how the profitability of firm is gonna get affected, so it is very important that whenever the firm look for investment, where they can do investment, probably there are a lot of ways are there to analyze a project. Whenever a company is going with a project, a lot of ways are there how a company can analyze a project. So we have learned a lot of capital budgeting principles. We have learned about NPV. We have learned about IIR. We have learned about payback. We have learned about payback, discounted payback. We have learned about accounting rate of return. Fine. So I hope you still remember all the things whatever we talked about. So out of NPV and IIR, we prefer NPV more than IIR. Then better avenue than IIR is MIRR. So many people say that we prefer MIRR also. So there are different ways are there. Whenever we have a project, we can analyze the project in much more different way. So one of the way when we go for much more better way of analyzing the project. So whenever we talk about something called strategic financial management. So whenever we talk about strategic financial management. So when we talk about strategic financial management. So when we talk about strategy. So like when we talk about financial planning and strategy, and how financial planning and strategy can bring much more a positive momentum to the company in the long run. So there probably we are talking about a time period which can be much more bigger than what we can see. So whenever we try to analyze the project either on the basis of NPV or IIR or ARR or payback or MIRR, we are actually emphasizing a lot on cash flow. They're emphasizing a lot on cash flow, and we believe that ultimately cash flow is much more better option than profit. We know why cash flow should be the better option than profit, but realizing too much on cash flow again can be sometimes problem for the company, because again ultimately the fundamentally the thing should be very strong. So because whenever we talk about analyzing a project, we need to give proper treatment to the capital expenditure. But more or less, when we talk about profit or cash flow, we give more emphasis to the revenue expenditure, because that is the way those things are got treated in the book of account of the company. That is the way how the tax regulatory body in our country govern the companies around us. So they directly or indirectly force to the company to give more emphasis to the revenue expenditure, but but how we can do the treatment of capital structure, that can be big thing. So when we talk about capital expenditure, so in capital expenditure, probably the fund what the company is putting on R&D, or the avenue what the company has created because the company have a patent. So such things gonna affect to the company in the long run. When you talk about employee retention, employee training, how you can talk about the valuation of human resource. So human resource valuation, again, it is very big event which the company need to think about. So frankly speaking, more or less, when we look into the valuation for the company, they give more emphasis to the tangible assets what we have around us. Instead of that, there are a lot of intangible assets which we need to look into, and still we need more sophisticated valuation tool for the intangible assets. Probably when we talk about R&D or patent or employee retentions, how we can assess the valuation of these. Again, this become very important. So all these things is being discussed under real option. I believe everyone can see my screen, so probably you can read whatever I'm talking about. So when we talk about capital expenditure or investment planning and control, it involves a process of facilitating decisions covering expenditure on long-term assets. Since the company's survival and profitability hinges on capital expenditure, especially the major one, the importance of capital expenditure investment process cannot be overemphasized. A number of managers think that the investment project have strategic element, and the investment analysis should be conducted within the overall framework of corporate strategy. So looking into the long-term vision for the companies become very important. So it's not about company, you can talk about government also. So why Chinese government, they're doing much more better? Because when you talk about China or Russia, what they are following that model where the governing body is going to survive for the long run, and then they are coming with such kind of policies which can work for them in the long run, and that way the corporate and the people have more trust on the company or the government. The same thing is happening better for them. You can say that is kind of positiveness for them. So that thing, when you, it can't be positive for country like India, where if a government start is some kind of, what do you say, bullet train project, and the next government which come in power, they try to halt the project. So such things create negative news in the market. So such things are there. So strategy, when we talk strategy can work in the long run. Strategy can work in the long run only when we see such kind of scenario where we have much more better vision for the future. So if we try to understand the relation between the corporate strategy and capital budgeting, because till now we are analyzing a project in the capital budgeting front only. Either we look into NPV, IIR, or ARR, or MIRR. So such kind of strategies, they do such kind of techniques are the techniques of capital budgeting decision. So we can go something much more better way, or much more holistically. If we see the changes, then we should look into the changes on corporate strategy front. So we need to understand some problem or some issues, like what are the strategic aspect of capital budgeting. We need to see, is the discounted cash flow techniques can handle the strategic aspect of capital investment, or they can evaluate an investment project that are capable of creating a future opportunity or flexibility for the company. So such are the very big problem. And when we study the subject like strategic financial management, we need to see something which is beyond uh, the numbers. So when we see the NPV, IIR, so they only talk about numbers. So they talk about the numbers, they talk about what can happen with the number on the company, but can we see beyond the number, or can we have much more better holistic vision of looking into the company? That should be the area where we need to look into. So when we talk about capital expenditure, it includes more or less the expenditure which is expected to produce benefit to the firm over the long period of time, and they should include both tangible and intangible assets. So you talk about R&D, you talk about patent, you talk about the brand. These should be the area where the company should work on. But more or less, when we see how the tax treatment is being done, so more or less, if such treatment also happens, so normally the companies, they do the expensing of these events in the year they have happened, and they don't think about the prolonging the mechanism of doing the valuation of these companies. So that can be again the area where we need to look into. So there are a lot of investment that may contain elements that can provide valuable opportunity to the firm in the future. Some investment may not be profitable but attractive for the opportunities that they are capable of creating in the future. For example, suppose a chemical company is there and they are investing in R&D. So if they come up with something new which can help them in the long term vision, so how they can do the treatment for that, that again is a big thing. Suppose there's a marketing company, so they have invested some amount of the capital for leveraging the sales to the other product. So maybe if they do such kind of advertisement, or if they spend too much on developing the supply chain network, so that automatically will show a kind of too much on their profit and loss account front. So will able to do the valuation of that event in the long term vision, and how an investor can understand what is happening with the company. The investor should not take decisions simply looking at the number. They should have to understand, they have to read the annual report of the company, and they have to understand why that the sudden dip has happened. So that more, what you say, more financial awareness, it is required in this front. So according to me, and either you talk about the two problems what I want to highlight till now. One is the problem of accounting of these intangible assets. One is the accounting of these intangible assets, and second is the financial awareness of the investors who go for the trading, who may go for short-term or long-term trading. How they come up, how they read between the lines of these events. Again, that is the something which we all need to be little bit more, what you say, more aware about how these things going to affect to us in the long run. So anyone have any doubt till now, whatever I have covered? Anyone want to say anything? Please write in the chat box. So probably what I'm gonna cover in today class, I'm gonna talk about something which is more strategic, that is called real option. So when we talk about real options are basically their strategic element. Real options are basically their strategic element in the investment that help in creating flexibility of operation, or they have the potential of generating a profitable opportunity in the future for the firm. So real option provides discretion to the managers to take certain investment decision without obligation for the given price. So basically, to work on the real option, whenever we talk a real option, whenever we want to analyze a project on the term of real option, where we try to see something beyond the techniques of the capital budgeting decisions. There we give emphasis to the option pricing framework, what we have learned till now. So I believe you still remember the option pricing model. There we talked about Black-Scholes-Merton model, and we talked about binomial tree model. So that what you studied in derivative, we're going to use here. So I hope you remember. We have talked about something like, we talked about the valuation of call option and put option. So when you talk about the valuation of call option, so when we talk about valuation of call option, so we used to find the two values d1. D1 was log e of s divided by k plus r plus sigma square by 2 into t into sigma root t, where d2 is equal to D1 minus sigma root T. So once we used to find the value of D1 and D2, then I can find the premium on the call option. So premium on the call option is S ND1 minus K e to the power RT into ND2. You remember, so similarly the premium on the put option, when you talk about the premium put option, that is K e to the power RT minus ND2 minus Sn minus D1. So these all we have studied in derivative. These all we have studied in derivative. So we have studied this valuation model in derivatives. So the same thing is being applied in corporate finance also. So what you have studied in derivative, you can apply the same logic in corporate finance. So if you apply the same logic in corporate finance, so probably you that strategy what you can imply in the corporate finance, that is called as real option. So we are going to talk about real option. So real option is again one of the techniques to analyze the project. So whenever we talk about analyzing a project, so we have these tools like NPV or IIR or payback or MIRR or ARR. We have these tools to analyze a project. But when we look into the domain of strategic financial management, so whenever we look into the domain of strategic financial management, then we talk about something called real option. We talk about something called real option, and that real option is based on the Black Scholes model what you studied. So this mathematically, this formula is what I've written. So this is the formula of such kind of stocks with no dividend yield. So such kind of stocks, this is the formula for stocks with no dividend yield. I hope you remember. This is the formula for the stock with no dividend yield. This is the formula for the stock with no dividend yield. So like that, we have the formulas. So if you remember in the Black Scholes model, so this is the formula for the stock with no dividend. Then we have lot of other formulas. So in the Black Scholes model, what we have studied, so is the formula. So then this is the formula. This is the formula. What you can see. So this is the formula for the. This is the formula either for currency option. This is the formula for currency option or the stock with dividend yield. This is the formula for currency option or the stock with dividend yield. This is the formula for currency option or the stock with dividend yield. So here you can see the two values of R is given. In currency option, you know that currency option is being affected by interest rate in home country, also the interest rate in foreign country. So you can see two R values. You can see the two R value here. You can see two R value. One is interest rate in home country. One is the interest rate in foreign country. So probably for the stock with dividend yield, we take two R value. One is if I talk about the stock with dividend yield. If I talk about the stock with dividend yield. So if I talk about the stock with dividend yield, under then the same formula will be used. Under there we use the same formula, but there what we do, there we use something called Q and R. So there we use something called Q and R, where probably this would be the interest rate, and this would be your dividend yield. So there we use this as an interest rate, and we use here this as a dividend yield. So because dividend yield, I hope you remember what is dividend yield. When we talk about dividend yield, I hope you remember what is dividend yield. So dividend yield is the formula which is basically the total dividend paid by the company, total dividend paid by the company in 1 year, paid by the company, total dividend paid by the company in last 1 year, divide by the, some people write here as the current market price, or some people take the average market price of last 1 year into 100. So whenever you do investment, in such kind of stocks which has the possibility to give you dividend in the future, that would be kind of positive sentiment for you. So that is also considered whenever we talk about the option pricing model. So all these I hope you still remember. All this we have studied in derivatives. We are simultaneously studying a subject called derivative. So the formula whatever we have studied there. So what the formula we have studied there, that stock with no dividend. So the formula whatever we studied there. So the same formula we are gonna use here. So when we talk about real options, so when we are talking about real option, when we are talking real option, in real options, what we do, we use option pricing model, and by using the option pricing model, we try to analyze a project. So you can read this case study. So this is a case study of a company called there's a company called Magic Food Limited. So there's a company called Magic Food Limited. So this company specialized in ready to make South Indian dishes. So this company, there's a company called Magic Food Limited. That company is right now in the market. It is just a case. So there's a company called Magic Food Limited, and they are specialized. They have market for South Indian dishes. So they are specialized in South Indian dishes. So what they are looking for, this company is looking for an idea of introducing. This company is thinking of introducing a breakfast cereal. So this company is thinking to introduce a breakfast cereal, and now this company is thinking to introduce a breakfast cereal. So what kind of analysis they are doing for coming with this project? So that information is given to you, that there's a lot of uncertainty about the demand for the breakfast cereal, since most Indians like traditional breakfast food like idli or paratha or khaman or dhokla or dosa XYZ. So now this company want to come up with some kind of breakfast cereal, but this company know that we Indians, we don't do much experiment with the breakfast. We try to follow a traditional setup for having the breakfast. So now the company is doing some kind of market research. So the company will initially introduce what the company is thinking, instead of coming with some kind of pan India, what you say, production around the country, and then maybe getting positive or negative, what you say, the impact around us. So what the company is thinking, they are thinking that they will introduce their cereal. They will introduce a cereal only in two segments. They are thinking that they will introduce a cereal in Delhi and Mumbai to judge the reaction of consumer and the pattern of demand. So they're thinking that they'll do some kind of test marketing. So they, instead of coming with the pan India, what you say, footprint, they are thinking that they will only come up with Delhi and Mumbai, so that they can judge the reaction of consumer and the pattern of the demand. So the estimated cost of production, is around, the cost of production is around 30 million. So to do the initial, what you say, the basic production, they need to spend around 30 million rupees. And the present value of estimated cash flow, what they're expecting from the project. So the present value estimated cash flow is around 21 million rupees. So as per their calculation, they have to do investment of 30 million rupees. So once they do that investment of 30 million rupees, then they can do some kind of test marketing. Then they can come up with some kind of initial, some product, some small unit of product which they will try to sell in the Delhi and Mumbai to understand the consumer reaction. But to do that test marketing also, they have to spend around 30 million rupees. But what they're expecting, that even after doing that, they are going to generate around only 21 million rupees. So this means that the project has a negative NPV of 9 million rupees. So I hope you're understanding. This company is planning that they are coming with a new project, and that new project, they are not thinking to come up with pan India footprint. They are just thinking to come up with some kind of test marketing in very small segment of market of Mumbai and Delhi. And in order to do that, they have to spend around 30 million rupees. And the estimated cash flow, what they expect to generate, would be around 21 million rupees. It means that from from the test marketing only, they are getting around a negative NPV. They are getting a negative NPV of 9 million rupees. And you know that the first rule of analyzing a project, you know that we give lot of emphasis to the NPV. And under that front, if we try to do that, you know that if you get a negative NPV, you know that out of NPV, IIR, ARR, payback, and all the techniques, you give preference maximum to the NPV. And you know that if you're getting a negative NPV, you shut down the project at that moment. So if this company is coming with this product called breakfast cereal, and if they want to do test marketing of the product, they have to do around investment around 30 million rupees, and from which they are expecting to generate around 25 million rupees, around 21 million rupees. That means that they are starting the project with a negative NPV of around 9 million rupees. So then they should go with the project, or they should halt the project at that moment, because once you get a negative NPV means, I believe, you have to shut down the project. I believe everyone remember the formula of NPV and all. In case if you have confusion with NPV, what is NPV? NPV is the sum total of your present value of your expected cash flow. So this is your NPV, sum total of the present value of your expected cash flow minus your initial investment, So that gives you something called NPV. So we whenever we look into the project, we give preference to the NPV. And in case if you are getting an negative NPV, I believe no financial manager will try to try to give green signal for such kind of project. So now what kind of the opinion the management have. The management believes that if the company does not introduce a serial, the competitor will do in the future. So that is a very valid point what the management have. They are thinking that if they will not introduce, then the competitor will introduce this product in the future, and then they will lose their then first mover advantage. So what management want? Management want to go with the project, although this project is giving them a negative NPV, but management want to go with that project. So now, so introducing the serial now will give them first mover advantage to the company, and if the demand pickups, then they have option to scale up the production in the future. I hope you still remember the decision tree analysis. We have done decision tree analysis, and I hope you remember. So we used to in decision tree analysis, we have studied some. We have drawn this kind of decision tree, and there we first try to see what is the initial investment and all. Then we used to analyze the project in two front. So if demand is high, if your demand is high, then what is going to happen? So we try to analyze the project in two front. If demand is high, if demand is low. So we used to analyze the project in these two fronts, and then based on that we try to estimate the expected cash flow. We try to estimate your expected cash flow. We try to estimate the expected cash flow from here and here, and then we know how to go back, and then we need to see then are you getting a positive NPV or not. But it doesn't matter you do this or do that. Here there's a probability associated with these two. There's a probability which is associated with these two. So the sum total of the probability is 1. And then what we used to do, we used to multiply the probability with the present value of your cash flow, plus we used to multiply the probability with the present value of your cash flow. Fine. And then whatever we used to get, we used to subtract with the initial investment. But again, what we are calculating again, so either you do decision tree also, but again what you are calculating the NPV only. Are you understanding? So we are too much dependent on NPV. So either you talked about simulation analysis, either you do Monte Carlo simulation, or you talk about sensitivity analysis, whatever the sophisticated techniques also, whatever we are working on, there also we are here or there, we are trying to calculate the NPV only. So that is the front what we need to look beyond it. So now we need to see something beyond the NPV. So there is a world waiting for us where we can look beyond the NPV. So now this real option can be the solution of looking into the analyzing a project where we can see the things beyond the NPV. So now the management believes that they should go with the project because then it will give them some kind of first mover advantage to them. Now if they will go ahead with the project, then the cost of expansion to the company is estimated around 50 million rupees if they will expand their project. Initially, you remember initially how much money they're putting. Initially, they are putting around the cost of introduction of the project is around 30 million rupees, and the estimated cash flow what they can generate is around 21 million rupees. Thereby, we are saying that they are getting a negative NPV of around 21 million rupees. Now, the company believes that they should go beyond to see the changes beyond the NPV. They want to get the first mover advantage, and if they will do the expansion of the project, then they have to spend around 50 million rupees, and from there they're expecting the life what they can expect that till the time that the competitor will not come to what you say will not try to attack them till they're expecting a life of 5 years, and in these 5 years they're expecting to generate around 45 million rupees. Now let analyze this project. This is the project with you where you can expect a standard deviation of 30% and risk-free rate of interest of 8% per annum. So I want to analyze this project. So should we go with the project or not, or can we see the changes beyond NPV? That is something we need to look into. So this is the project what you can see. Really, everyone please write down the important data. All the data which is there in yellow color, please write down these data so that we can solve this problem. Now we are going to solve this problem. So before we solve this problem, I believe everyone is listening to me. So please write down these data. Everyone please, I'm giving you 2-3 minutes time or take 5 minute time. Read this case study, try to understand what is written in this case study, and write down the important point in your notebook. Then we'll solve the problem. Or if you are working on system, then please write down in your laptop. Whatever is convenient mode for you, please write down this data. Now we will solve this problem. We use MS Excel. We use the calculation also by using calculator. So I'm assuming that you all are sitting with calculator, most probably scientific calculator or normal calculator, doesn't matter, or you're sitting with MS Excel. So we solve this problem. So before that, I'm giving you 5 minutes time to understand what has happened. Anyone have any doubt? Anyone want to ask anything? Anyone want to ask anything? Anyone? So everyone, please write down this problem. Everyone, please write down the important fact of this problem. Then we'll solve this problem. I hope everyone sitting with calculator and Excel. If not, then please arrange yourself so that we can start solving the problem. So I'm giving you 2 minutes time to read everyone, and then we'll start solving this problem. Now, this I will share with you all. This in future, after the class, I'll share this Excel sheet with you all. So I believe now everyone is ready. I believe no one have any doubt. So in the chat, I can't see any doubt. Now, this problem, what I wrote for you, now the same problem I can solve. Uh, who has left the class? Prakash is there, Amit is there, Gaurav is there, Meghna is there, Neetu is there, Pooja is there, Rashmi is there. Hmm. Hmm. Some sound I heard. Okay. Everyone is there. No? Ravinder is not there. Okay. Prakash, if you want to say anything, please write in the chat box. Okay. So I think Ravinder has went away. Hmm. So anyway, guys, this is the problem. This problem I can solve. To solve this problem, you have seen the case study. Now, to solve this problem, there's a mathematical model. What I have developed. This is the model for the valuation of the expansion of a option. So, what we are studying right now, we are studying something called real option. So, if you want to do the valuation of the real option, so this is the option to expand. So, under real option, what we are studying, we are studying an option to expand. We are talking about option to expand. We are talking about option to expand. Now, when we study this real option, where we are studying the option to expand. So although I told you mathematical formula for solving this problem, although I told you the mathematical formula for solving this option, so I told you this formula. I have told you this formula to solve this problem. I have told you this formula. So instead of solving this problem, you can solve with a mathematical model on MS Excel. You can solve this problem. So here, if you read this program calculates the value of the expansion project in their investment analysis. So here you just need to put input. If you put the input, your work is done. So here, if you see the first option, the first, what you say, the first question is that enter the present value of the expansion potential. So what enter the present value? So how much you expecting from this project? So how much you expecting from this project? So from this project, I'm expecting around 45 million rupees. So I from this project, I'm expecting around 45 million rupees. So enter that value. Okay, enter that value, then enter the annualized standard deviation. So as per my calculation, the standard deviation what I'm expecting is around 30%. Enter the initial investment, so that is around 50 million. Then enter the number of year you have the right to project. So I'm assuming that this breakfast cereal, what I'm gonna do that. So the life of that project will be around 5 years, and enter the cost associated with that. That is not required. So with this, the RF, risk-free rate of interest, if you enter everything, then it will calculate the D1 and D2. I hope you remember the D1. What is D1? D1 is log E of S divided by K plus R plus sigma square by 2 into T by sigma root T. So here what we are doing, guys, what we are doing now, you will be getting confused what I'm talking about. Here what we are talking about, here we are analyzing the project. And under real option, whenever you do the valuation, whenever you do the option of valuation of option to expand a project. So if you are trying to analyze an option to expand the project, so here we use the formula of derivative of Black-Scholes model. But if you use a formula of derivative, now the question arises: what is S? So what is S? If you remember in Black-Scholes model, what was S? S was your stock price. So here, what is your S? S is the present value of the cash flow to be generate from the project. What is S? S is the present value of the cash flow to be generate from the project. That is your S. That is your S. Now what is K here? What is your K? K is your, what is K? K used to be strike price. What is K here? What is your basically K? K is your initial investment. K is your initial investment. So if you see in this project, what is your S? S means what is the present value of the cash flow you are expecting from this project. So the S, you are expecting around $45 million from this project. And if you see K, your cost of investment, the cost of investment is around $50 million. And since you can see your S is less than K, so it is kind of out of money option. If you remember the option pricing model, so it is kind of out of money option. So guys, you have to understand that whatever you have studied, whatever you studied in derivative, we are trying to imply the same thing in the term of option pricing model. Whatever we studied, we are using in corporate finance, where what is your S? S is the present value of cash flow, what you are expecting to generate from the project, where K is your initial investment. So you are putting around $50 million for the project, and the cash flow you are estimating to generate from the project is around $45 million. The R, all the other values are given to you. Standard deviation is around 30%. Risk-free rate of return is around 8%. And the time you are expecting from this project is around 5 years. So these all data is given to you. So now the same data, now this data is already, everything is given to you. Now this data you can use in the derivative. You can use this data to calculate D1. So D1 is nothing but log E of S divided by K plus R plus sigma square by 2 into T by sigma root T, and then D2 is equal to D1 minus sigma root T. So what we studied, the same thing we are using here. So here, when we do this calculation, we assume that the option to expand, we assume that the option to expand, we assume that the option to expand, we are assuming an option to expand as the what do you say, as the valuation of stock with no dividend, valuation stock with no dividend, as per the Black-Scholes-Merton model. Okay, so this option to expand, whatever we are dealing, whatever I'm talking with you, this option to expand, this case study, what we're studying about this company which want to introduce the breakfast cereal. So that option to expand, should they do or not do? Because if you remember the case, in this case, if they do the initial investment also, they are putting around 30 million, and they are going to generate 20 million. And then if they start the project, they have to put around 50 million, and they're going to generate around 45 million. In every case, you can see they are getting around negative NPV. So should they expand or not? So if you see the NPV front, they are getting a negative NPV. So should they do or not? So here what we are studying, we are talking about the valuation of stock. Here in this, to analyze this project, what I'm using the Black-Scholes model. That Black-Scholes model, what you studied already. So I'm using the same Black-Scholes model, where I'm talking the valuation of stocks with no dividend here. Where what is S here? What is your S? So S is the present value of cash flow, what you can generate from the project. What is your K? K is your initial investment. So if you remember from this case, the money what you're expecting to generate from the project, if they will work on the project, they will generate around $45 million. That is a present value of cash flow what they're expecting to generate. I hope you remember that to calculate the present value of cash flow, to calculate the present value of cash flow, what we'll do, we assume the future cash flows. We assume your future cash flows, whatever the future cash flows you can generate from the project, and that we discount all those cash flows with their WACC. We estimate the future, all the cash flows, whatever you expect to generate. This, if we discount with the WACC, these future cash flows, if we discount to the WACC, this future cash flows, whatever you're expecting to generate, these cash flows, if you discount with the WACC, then you get the present value of cash flow. So this present value of cash flow, what you're expecting to generate, that is around $45 million that we are assuming as a S. Then the money what you're putting, that is your initial investment, that we are putting as K. Now what we are using here in the option to expend, we are using Black-Scholes model. We are using Black-Scholes model. So initially we'll calculate the value of D1, and then we calculate the value of D2. Once we calculate the value of D1 and D2, then we'll, from the D1 and D2, we'll find the value of ND1, ND2, N minus D1, and N minus D2. We'll find the value of once we get the value of D1, D2, we'll calculate the value of ND1, ND2, N minus D1, N minus D2, where you remember the sum of ND1 plus N minus D1 is equal to 1, and the sum of ND2 plus N minus D2 is equal to 1. So to find the value of ND1, to find these values in MS Excel, if you want to find this value in MS Excel, you can use the function in MS Excel called normdist. In MS Excel, once you get the value of D1 and D2, you can use a formula called normdist. So D1, D2 mathematically we'll find by using this formula. Once we find the value of D1, D2, we use the normdist function in Excel to find the value of ND1, ND2, N minus D1 or N minus D2. Or what I can do, I can use the table. There's a normal distribution table. 1 minute. So there's a table. The table, I have table. Just remember now, this normal distribution table. So, or if you are doing with calculator and notebook, I hope you remember this table, normal distribution table, or manually we can calculate ND1, ND2, N minus D1, N minus D2 by using this table. Or in Excel, we can use the normdist function in Excel. So with that, we'll get the value of ND1, ND2, N minus D1, ND2. Once we get that, then the value of option to expend, if you want to calculate the value of option to expend, if you want to calculate, then it is calculated by the formula called SND1 minus K e to the power RT into ND2. Okay. So that gives you the value to expend, where what is S? S is your present value of cash flow, what you're expecting to generate. What is K? K is your initial investment. Once you do this calculation, once you've done that calculation, here you can see this option to expend. This is nothing but S and D1 minus K e to the power RT into ND2. So it is giving you around $17 million. So it is giving you around $17 million. You can see this is giving you around $17 million. Now what you can do, if you see this data what I have talked about, so the value of option to expend, if you do the option to expend, if you do the value of option to expend, then it is around 17 million rupees. Doesn't matter what unit of currency I'm talking about. The project, without considering the project, if you read this, so if you read this line, the project without considering the expansion have the negative NPV, you know from beginning, and the value of project with the option to expand is NPV of the project plus the value of option to expand. So the NPV of the project, if you remember, what was the NPV of the project? So you are putting 30 million rupees, okay, for the initial test marketing, and you are estimating to generate around 21 million rupees, if you remember. And now from this value of option to expand, if you expand it, if you remember the problem, so when you're doing the initial test marketing, you had to put around 30 million rupees, if you remember, and from there you are expecting to generate around 21 million rupees. So there you are getting a negative NPV of 9 million rupees. So that's why many people, to simply see NPV, they will tell to better to shut down the project. But if you take the risk of expanding, if you take the risk of expanding and you do an investment of around 50 million rupees, and where you are estimating to generate around 45 million rupees. So if you calculate the option to expand, if you calculate the option to expand by using the Black Scholes model, you are estimating to generate around 17 million rupees. You are estimating to generate around 17 million rupees. So if you do the calculation now what is the now if you calculate now what is the value of the project to expand. So if you do this calculation, so you are getting around a positive NPV of around 8 million rupees. So this is the case study. This is the way. This is something called real option, and this is the in real option there are a lot of models we need to study. Right now, what I'm teaching you, I'm teaching you the option to expand. This is about option to expand. Anyone want to ask anything? Anyone want to ask anything? So I believe everyone sitting with notebook and Excel. So how many of you are sitting with laptop? So like let's do then on Excel only the same thing. Okay, Amit is in Excel. What about others? Ravindra is with Excel. Meghna notebook. So we'll try to use both of them. Rashmi with Excel. Okay. Pooja Excel. Okay. So Gaurav is with notebook. Okay. Okay. Okay, I'll try to do both Excel and notebook because people are sitting with both notebook and Excel. So we'll use both. So we'll use both. So you can see your initial investment. If you read your initial investment. We do both. Don't worry. So those who are sitting with anything, they will not face any problem. In the initial investment was around 50 million. Around 50 million. Initial investment is around 50 million rupees, and the present value of cash flow is around 45 million. Present value of cash flow is around 45 million. So in this problem, what is RF? Risk-free rate of interest around 8%, 8% per annum. Now standard deviation. Standard deviation is around 30%. Standard deviation is around 30%. What else? Present value RF, standard deviation, time period. Time is 5 year. Time is 5 year. This is your time period. The time is 5 year. Correct, na? The time is 5 year. So from the case study. So Initial investment is 50 million, time is 5 years, the present value of cash flow 45 million, standard deviation 30%, RF is 8%. Okay. Now once you get this, now we'll calculate the D1, we'll calculate the D1, we'll calculate the D1. The formula of D1 is log E of S divided by K plus R plus sigma square by 2 into T by sigma root T. What is sigma? Sigma is standard deviation. And I hope everyone knows sigma means standard deviation. Okay. So let's calculate the D1. So let's calculate the D1. Now, if I calculate the D1, let's calculate the D1. What is D1? Everyone, D1 log E. Log E means ln. Log E means ln. If you remember the project also what I gave you for your corporate financial modeling, there in that case study it was written ln. ln. In Excel, if you write ln, that is log E. Or maybe after the class, I'll send you this Excel sheet. You can see that. In case if you miss me, so log E means ln. So ln log E is ln. So ln S divided by K. This is your S. Present value of cash flow is your S, and your initial investment is your K. S divided by K. Log E of S divided by K plus R. What is R? R is your 8%. R plus sigma square. This is sigma is 30%. Sigma square by 2. So by 2. This you multiply with time. What is your time? Time is 5 years. This you multiply with time. Time is 5 years. This you multiply with your time. Time is 5 years. Clear everyone? So write down this formula. Log E means ln. Log E of S divided by K plus R is your what R risk-free rate of interest. So the what is RF? RF means risk-free rate of interest. That is the rate of interest what you can expect to generate without incurring any risk. That is called risk-free rate of interest. This you divide by the sigma root T. So what is sigma? This is sigma. Sigma into root T. Root T means square root. Time is 5 years. So with this, we'll calculate the D1. D1 formula is log E of S divided by K. S. What is S? S is the present value of cash flow. You are estimating to generate. K is your initial investment. R is the risk-free rate of interest. RF, that is called risk-free rate of interest. Sigma is your standard deviation. T is your time period. I hope this is clear now, everyone. Everyone clear now this? D1, everyone done with this calculation? Once you get D1, now you can find D2. What is D2? D2 is, once you find D1, what is D2? You can calculate D2. D2 means D1 minus sigma root T. So this is D1. D1 minus sigma. Sigma is 30%. Root T. SQRT of T. T is 5. This is your D2. So you get D1 and D2. Do this calculation. Anyone have any doubt? So calculate D1 and D2. Same thing we have already studied in Black-Scholes model. Same thing I'm just repeating. SQRT मतलब square root में ना. SQRT means square root because you have to do, if you see this formula here in this formula, if you see in this formula, sigma square sigma root t. So root, for finding the square root we are using t. We are using SQRT. SQRT means square root. Done, everyone? So I believe this is done, no? So once you're done with D1, once you've done with D1, you can find D2. D2 is nothing but D1 minus sigma root T. Once you find D1, you can find D2. D2 is nothing but D1 minus sigma root T. I believe D1, D2 is done with everyone. I believe D1, D2 is done with everyone. Now once you find D1 and D2, you have to, once you're done with D1 and D2, now once you're done with D1 and D2, once you get the value of D1 and D2, you have to find the value of ND1 and ND2. So how to find ND1 and ND2? So you can use a formula ND1. ND1. So ND1 is nothing but, use a formula called norm dist. So that will give you ND1. Use a formula called norm dist. So you'll get the value of ND1. Once you get the D1 and D2, use the formula norm dist. If you use norm dist, you will get the value of ND1. Clear now, everyone? Use the formula norm dist to get ND1 and ND2. So you got ND1. Now you get ND2. So what is ND2? Same thing. Same thing, only now just take D2 there. So you'll get ND1, ND2. I believe this is done with everyone. So once you get ND1, ND2, now what is the formula of option to expand? The formula of option to expand, what is that formula? So the formula of option to expand, what is the formula we're going to use? For the option to expand, we're going to use the formula for the option to expand, for the option to expand. So we're going to use the formula called SND1 minus Ke to the power RT into ND2. So we're going to use this formula. So let's do this. So what is S? S is your present value of cash inflow. That is your S. So that is your S. S into ND1. This is your S into, this is your S into ND1. What is ND1? This is your ND1. S into ND1. This is your ND1. This is S into ND1. This minus, you can see the formula S into ND1. You can see this formula S into ND1. What is your S? What is S here? S is the present value of cash inflow minus K. Minus K. What is K? K is your initial investment. What is your initial investment? Your initial investment 50 million into E. E in Excel is used written by the formula called EXP. E in Excel, we use EXP for E. E to the power minus RT. Minus R. This is R into T. E is 5 years. In Excel, E is in Excel for using Euler number E, we use the function called EXP. So S and D1 minus K e to the power RT into ND2. If you do that, so you got around 16 million. 16.988. This is the formula what you have to use. Where S, what is S? S is your present value of cash inflow. ND1, ND1 already you calculated. ND1 and ND2. E in Excel, we use a function called EXP. Clear? Anyone have any doubt? Please write in the chat box. If anyone have any doubt, please write in the chat box. Amit, beta, listen here, everyone. This can you see in this 1 minute? Can you see this E here? This is E to the power. This is E to the power minus RT. You have to do, guys. See this formula K. What is K? C2, C2, K. C2 is your initial investment. K into E to the power minus RT. E in Excel. In Excel, E is represented by the symbol called EXP. S is your present value of cash inflow into ND1 minus K. K is your initial investment into E. E in Excel is represented by the symbol called EXP. In here, power sign does not work when you use in Excel. When you're working in Excel, we don't when you work on Excel, like e to the power RT is there, so we write EXP into RT, because anything you write under EXP will be in power only. Anything you write under EXP will be in power only. Clear, guys? Anyone have doubt? Anyone have any doubt? Hmm. So, so once you're done with that, once you get that value, once you get that value, so now once you get that value, now you can analyze this, that the value of option to expand is 17 million rupees, and the project without considering the expansion option has negative NPV, and the value of the project with the option to expand is the NPV of the project plus the value of option to expand. So the value of the project with the option to expand is, like, if you remember that initially they are putting 30 million rupees, from which they are expecting to generate around 21 million rupees, and then from the NPV, from the value to expand, they are generating an NPV, they are generating an NPV of around $16.99 million. So hence the option to expand is around positive 8 million rupees. So they should expand the project. This is the overall problem all about. Now, in order to do the same thing, now do the same thing with in notebook and all. If you want to do the same thing in notebook, use the formula. So when you talk about the valuation of option to expand, valuation of option to expand, valuation of option to expand. So if you do that, then S is your present value of cash inflow. It is around 45 million rupees. Then K is your initial investment. K is your initial investment. That is around 50 million rupees. Yes, Ravindra, we did know that this is your K 50 million. We have used here in this calculation initial investment of 50 million. S is your present value of cash inflow. Then your RF, risk-free rate of interest, is 8% per annum. See, Ravinder, I'm using Ravinder here. So your RF is 8% per annum. Sigma is 30%. Okay, so sigma square, that is nothing but 30% square, that would be around 0.09, and the time period here is 5 years. So please write down this information. Please write down this information. I believe everyone written down this information. Now based on this information, I'll calculate D1. D1 is log E of S divided by K plus R plus sigma square by 2 into T by sigma root T. So I'll calculate my D1. So my D1 is log E of 45 by 50 plus R is 8% plus sigma 0.3. Sigma is 0.3. 0.3 square by 2 into 5 by sigma is 0.3 into root 5. You do this calculation with scientific calculator. Log E means ln. If you're using scientific calculator, then log E is ln. So if you do this calculation, if you do this, you'll get the D1 value. Those who are sitting with notebook, if they'll do this calculation, they'll get D1 value as around 0.7746. So you'll get D1 value called 0.7746. Now, if you do D2, D2 is D1 minus sigma root T. So if you do D2, D2 is 0.7746 minus 0.3 into root 5. So you'll get D2 around 0.1038. You'll get D2 around 0.1038. So you can do this calculation from yourself. These all are easy calculation. So you can do this calculation D1 and D2. So once you find the value of D1 and D2, now you can use this normal distribution table to find the value of ND1, ND2, N minus D1, N minus D2. You can do that. So if you use the normal distribution table for ND1, that is N of 0.7746, 0.7746. So you use the formula N of 0.77 plus 0.46 is equal to N of 0.78 minus N of 0.77. So you can do this. So if you use this, you will get the ND1 value. You'll get ND1 value. You'll get ND1 value as 0.78072. You'll get 0.78072. Similarly, you can find the value of ND2. Similarly, you can find the value of ND2. So the ND2 value, what you will find is 0.5413. So that is 0.5413. So once you found the value of ND1, ND2, now you can calculate the option to expand. So now the option to expand. So here that is nothing but here we calculate the premium of a call option. Premium of a call option. So that is nothing but S and D1 minus K e to the power RT into ND2. S is 50, ND1 is 0.78072 minus S is 45. S was 45. So S was 45 minus K is 50 into e to the power minus R. R is 8% into T into ND2. ND2 is 0.5413. So if you do this calculation, you will get around 17 million rupees. Option to expand. So once once you do this calculation, you'll get the option to expand. You can do this calculation from your end. So I have little bit limitation of time. Again, I have another class. Today I have around total 8-hour class. So in a day. So now again I have another class from 11:30. So I'm little bit fast I'm doing. I believe you can do all this calculation. All these recorded, you will get the So you can calculate this. In case of doubt, I'll clear you doubt in next class. And once you're done with that, you can simply understand the value of project with the option to expand. So you can write the value of project, value of project, value of the value of the project, value of the project, value of the project with option to expand is with option to expand is around, first you are putting 30 million, you are generating 21 million. Now with option to expand, you are going to expect to generate around 17 million. So you are getting around positive NPV of 8 million. Clear? Anyone have any doubt? Anyone have any doubt? Ravinder, you're not understanding. So starting, if you remember, the initially, if you do the test marketing and all, you had to put around 30 million. You are putting 30 million, you are generating 28 million. So it was giving you a negative NPV of 9 million. Now here, now you had confusion that you are getting negative NPV of 9 million. Then you should go ahead or not. If you see simply NPV, then it means that you should not go ahead. But if you consider the real option of the option to expand, where if you put 50 million, where you can expect to generate around 45 million, then you are getting a real option value of around 17 million. So that is giving you positive NPV. I'll send everything. Then you are getting a positive NPV. I hope you are understanding, Ravinder, that this case is like divided in two parts. Okay, first part you are putting 30 million, you are getting 21 million. So means you are getting 9 million negative. If you get 9 million negative, means you should not start. If you are getting 9 million negative, means you should not start. You are getting 9 million negative, means you should not start. But if you expand, if you think about expansion, then you are generating 17 million, where you are putting 50 million and you are generating a cash flow of 45 million. That is giving you option to expand of around 9 million. Sorry, around 17 million you are getting from there. So now sum total of everything if you do, so then you are generating a cash flow of around 8 million, which is a positive NPV. So you should expand the project. So we are just talking about the option to expand. Should you expand or not? 17 million, we are not talking about NPV, Rashmi. 17 million is the value to option to expand. 17 million, we are talking about the option to expand. Should you expand or not? 17 million, we are using a new mathematical formulation based on Black-Scholes-Merton model. So based on Black-Scholes-Merton model, we used the same pricing formula what we use in option valuation. The same thing we have used here, and by that we have calculated the option to expand, which is coming around 17 million. So that is giving you much more bigger figure than what you get by traditional NPV approach. So today we learned something new, which is called a real option, where we try to analyze a corporate finance scenario by working on the concept of Black-Scholes model, what we have studied in derivatives. So okay guys, I need to wind up the class. I hope you have understood whatever I have done. So I will send you everything. Okay, so it was really nice teaching you all. to see you soon for the next class. So thank you everyone. God bless you.